Bitcoin is under pressure again, but price alone does not explain the full story. The real question is whether liquidity, ETF flows, macro conditions, positioning, and investor behavior are still supporting the market. Welcome to the Calm Metrics. This video is not financial advice, and it is not a trading signal. It is a calm market brief designed to read the data before reacting to the price. When markets move quickly, emotion becomes louder than data. Some traders chase the first bounce because they fear missing out. Others panic after the first drop and expect an immediate breakdown. But one candle is never enough to understand the whole market. The first layer is price structure. A stronger market does not only bounce, it stabilizes. Buyers need to defend important areas with real participation. If structure keeps weakening, the market becomes more fragile. This is why the Calm Metrics does not chase the first green candle, and we do not panic after the first red candle. Structure comes before emotion, and confirmation comes before confidence. A market under pressure must prove that support is real. The second layer is ETF flows and institutional demand. Bitcoin can move fast in the short term, but sustained moves usually need real demand behind them. When ETF inflows are strong, they can support confidence and add marginal demand to the market. When ETF outflows appear, part of that support may begin to fade. ETF flows are not the entire market. They do not guarantee that Bitcoin must rise or fall, but they help us see whether large buyers are adding support. If price is weak while demand is weak, the market needs help from other layers. That help can come from stablecoin liquidity, macro conditions, long and short positioning, or a shift in investor behavior. Without confirmation from those layers, a bounce can stay fragile. Demand matters because hope alone cannot hold a market for long. The third layer is stablecoin liquidity. Stablecoins often act like dry powder inside crypto because they represent capital that may already be close to the market. If that capital is healthy, the market may still have fuel. If liquidity weakens, rallies can become more fragile. Price is the headline, but liquidity is the engine beneath it. A market can bounce briefly on emotion and short-term excitement, but a stronger trend usually needs capital, depth, and participation. That is why liquidity matters more than hype. Liquidity does not predict every candle. It does not tell us the exact next move, but it helps explain whether a move has support behind it. When liquidity weakens, price action can become easier to shake. The fourth layer is macro. Bitcoin does not move in isolation from the wider financial system. Rates, the dollar, equities, yields, and risk appetite all matter. When macro pressure rises, investors usually become more selective. A stronger dollar can tighten global liquidity conditions. Weak equities can reduce confidence in risk assets. Higher yields can make investors demand stronger evidence. Crypto may feel independent, but the background still matters. This does not mean macro controls everything. Bitcoin can still move on its own narrative for a period of time, but the wider market sets the temperature around risk. A calm investor always checks the environment before trusting the move. The fifth layer is long and short positioning. When Bitcoin is under pressure, we do not ask who wins. We ask who is exposed if the market moves quickly. That is where funding rates, open interest, and liquidation zones become useful. Funding rates can show which side is paying for exposure. Open interest can show whether leverage is building or clearing. Liquidation maps can show where forced exits may accelerate. Together, these tools create a pressure map, not a trading signal. If late longs are crowded, a further drop can force them out. If aggressive shorts are crowded, a sharp bounce can squeeze them quickly. The point is not to predict a squeeze before it happens. The point is to respect where instability may be building. The sixth layer is investor behavior. When markets weaken, fear and greed become louder than logic. Some traders buy too early because they fear missing the rebound. Others short too late because they think weakness must continue. Fear can be useful information, but fear is not a buy signal. Greed can show momentum, but greed is not confirmation. The market often punishes emotional entries before direction is clear. This is why discipline matters more when pressure increases. The calm metrics checklist is simple. Is structure holding, or is the market losing strength? Are ETF flows stabilizing, or is demand still under pressure? Is liquidity healthy enough to support the next move? Are macro conditions helping, neutral, or creating pressure? Is positioning balanced, or is leverage becoming crowded? Is investor behavior calm, or is emotion starting to dominate? These questions matter more than one fast candle. A stronger setup has several layers working together. Structure stabilizes, liquidity remains healthy, and demand improves. Macro pressure cools, positioning stays balanced, and behavior becomes patient. That kind of alignment gives the market stronger confirmation. A weaker setup looks different. Structure keeps fading, liquidity does not improve, and demand stays weak. Macro pressure rises, leverage becomes unstable, and emotion takes control. When several layers weaken together, the market becomes more fragile. Bitcoin under pressure is not a prediction by itself. It is a test of structure, liquidity, demand, positioning, and discipline. The important question is not only where price is today. The important question is whether the market has enough support behind it. The key takeaway is simple. Do not read price alone. Price is visible, but liquidity, demand, macro pressure, positioning, and behavior explain the deeper story. Stay calm, read the data, and respect the risk. That is the calm metrics way.